Hello and good evening. I'm David Gill, Head of Product Management at Stockbrokers Self-Trade, and it's my pleasure to welcome you tonight to the first of what is a series of 3 webinars looking at the topic of self-invested personal pensions. I'm delighted to say I'm joined by Francis Moore, Managing Director of European Pensions Management, and he's going to be taking us through the first of these 3 seminars, and I'll be introducing Francis in just a moment. But before I do, let me just cover a few housekeeping points. Now, beneath the screen that you're watching, you should see a box where you can enter questions. If you have a question you'd like to send to us, just type it into the box and click on the submit button. Now, we will know who sent it because we've collected your details when you registered. However, if you are seeing a box that says and asks you to enter your email address, then please put it in there, because if we don't get time to answer each of the questions tonight, then we do hope to get back to you, and that will enable us to do so. Don't worry, we won't be sending you lots of emails afterwards. Don't worry too about taking notes as we go through. We will be recording this webinar tonight, and it will be available on our website in a few days' time. Now, this webinar follows our series of seminars, and the footage of that seminar will also be available on the Self-Trade website in a few days. So, if you've a cup of tea to hand and you're ready to go, let me introduce Francis Moore. Now, if you've been able to read the details on screen in front of you, you'll know that Francis truly is an expert in the world of SIPPs. He's been engaged in SIPPs from the very, very start, and indeed is credited with setting up the very first scheme. And I understand, Francis, you even have one for your son as well.
Indeed, I do, Dave.
Now, Francis is going to be taking us through tonight's topics, which cover choosing the right trustee and administrator, how you actually go about opening your SIPP account, and then how you transfer investments or cash into it. So, without further ado, let me hand over to Francis, and I'll be back to join you for the question and answer session in about half an hour's time. Francis.
Dave, thanks so very much. Well, firstly, I'm going to start this evening with, I'm afraid, a health warning. Because although we've entitled this as a starting your SIPP, the very first question you need to actually ask yourself is the SIPP the most suitable product for you? We're going to be talking about different varieties of SIPP, but you should actually consider whether a stakeholder pension or perhaps a personal pension is actually more suitable for you. Of course, you may also have pension provision in the corporate sector, so you may already be in a company pension scheme, or indeed that very rare fish now, the final salary scheme. So our health warning is to consider whether you should have a SIPP in the first place, because there are considerable responsibilities on you, the member, in terms of dealing. And it really is important that you understand that you have to take the full responsibility for your actions. So now I'm going to move on and discuss SIPPs. And the first thing that I need to cover is the different types of scheme within the SIPP arena. Probably the most common is what we call a master trust arrangement. This is a trust that's established separately from the scheme operator and will typically involve a trustee and a scheme administrator. But there's one scheme where all the members are actually aggregated into the one scheme, though their assets are kept separate and accounted for separately. The second type of scheme is a variant on the master trust, and this in fact comes from really the small self-administered scheme market, which is a master trust sub-trust construction. And here we may see a combination of trustees, the professional trustee, and within the sub-trust the member actually acting as a trustee and being a signatory to the arrangements. The difficulty there is that sometimes that construction can be a little more expensive to run, because effectively you're having to deal with more signatories, etc. The third type of scheme is something called deed poll, used commonly by insurance companies. I know of only one SIPP scheme that was ever established under deed poll, and indeed I understand that that particular insurer has moved to a master trust arrangement. So those are the 3 different types of scheme that you can possibly have. Now, in terms of choosing a trustee and scheme administrator, and I'll come back in a moment to discuss whether you need to have a single trustee and scheme administrator or not. But the important thing is to really try and establish, well, what do I really want to do with my SIPP? So it's not like selling a box of cornflakes or shreddies. A SIPP is a very powerful framework. You get a lot of investment choice. But do you need a full-size SIPP? Do you need one that perhaps is charged at £750 or £1,000 a year with lots and lots of features, commercial property investments, hedge fund investments, personal private equity investments? These all add to costs. Maybe you want something rather simpler. Maybe you just want to wrap a single SIPP trading account like the ones that Self-Trade offer. Now, the charges for that type of arrangement are much, much less. So you really do need to decide at outset, well, what do you want to do with investments? That's the most critical decision. Do you want to appoint someone to advise you to help with investments? Do you want to appoint someone to be a discretionary investment manager? And some of these things that we'll be exploring in some of the future webinars. So cost is key, and that's one of the messages that we need to get across, is that you don't need to be paying more than you have to. In terms of choosing a trustee, well, one of the first places you can go to is actually to the Self-Trade website, where I think you'll find something in excess of 40 SIPP trustees and administrators offering their products. And I think a quick run round, you'll see the different types of charging structures, etc. Also, you could Google, and another place that very often that you can find SIPP trustees and administrators is actually to find those that have linked up, like Self-Trade has, with specific trustees and administrators, some of whom offer preferential terms. Having looked at the SIPP trustee administrator, one of the points that I was going to come back to was the need actually for the trustee and the scheme administrator to be the same person. Now, very often they are, and that can provide some cost advantages, but it is perfectly possible to have a trustee who may just be a bare trustee and the scheme administrator. The key thing, however, whoever the trustee or the scheme administrator is they must be regulated by the Financial Services Authority. That requirement came in April 2007. I think, generally speaking, everyone would be regulated, but it is worth just double checking that your scheme trustee or your scheme administrator are regulated to be the scheme operator. The scheme operator also needs to be involved with the HM Revenue and Customs, HMRC, because of collection of tax reliefs and payment of tax that's due on pension schemes. And again, we're going to come back in more detail to discuss those particular aspects in future webinars. Now, having made the decision about the trustee and scheme administrator, how do you actually apply to have a SIPP scheme? Well, broadly, you're going to have a SIPP scheme that's established by paper. Pension schemes tend to be a bit more complex. There are one or two that are actually offering online facilities to be able to apply, but by far the majority of SIPP schemes are set up using a paper process. However, you may be able to download those from the relevant scheme administrator or trustee's website. Going alongside the application form process, there are a number of documents, because SIPPs are regulated by the Financial Services Authority, that you'll be required to review, and these can range from a conflicts of interest policy, terms of business, which set out the full terms of the SIPP arrangement, and other documents such as key features, which are required as part of the product sales process. Now, those may be available to you on a website, or indeed some practitioners may send those to you as part of the post-sales pack. One of the features introduced is that if you're doing distance, if you're taking on the SIPP yourself as an execution arrangement, then in all cases SIPPs have a 30-day cooling off period, and you may or may not be invited to cancel out that period if you're in a hurry to make an investment, you see the markets moving up and you feel that you want to get cash across, then you have the opportunity to close out that cancellation period. But it's there for your protection, so think carefully before you sort of automatically perhaps tick a box to say that you want to cancel out your cancellation rights. So the application process will cover off details about you, details about beneficiaries that you may wish to include for the purpose of death benefits, and again we'll come back to death benefits in a future webinar. The application form will also cover off your selected retirement age, and again we're seeing movements, of course. You'll be reading in the press and you've been hearing about changes that are proposed by the government in the retirement zone, and we'll touch on those again in the next webinars. But you'll want to select a pension age that's not fixed. That can be from age 55 up to currently age 75/77. And that can be varied. So you could select an age of 65, but you get to 65 and you decide to extend your pension arrangement. That shouldn't be a problem, but be careful, look at the contract terms that you're taking out with a particular provider and just make sure that there's not going to be a charge made for making that extension. In addition to the main application form, there is likely to be a contribution form for those of you that want to make contributions, single contributions or regular contributions. And probably the most common form is going to be actually a transfer in form, because it's most likely that you're going to be taking transfers from previous pension arrangements. And that's one of the strengths of the SIPP scheme and of SIPPs, is that you can actually consolidate your pensions into one pot and effectively pay one set of charges against that whole pot, rather than implicit charges or direct charges for other arrangements. In addition to the pension scheme application process, it's likely that if you're combining it with, say, a self-trade SIPP dealing account, that you'll need to complete application forms in relation to the self-trade account as well. And in that particular case, it's a 4-section form, including the details about us perhaps as a trustee, the scheme administrator, and your own details to set up the dealing account. The trustee completes that section and then sends it on to self-trade. So the application process is fairly paper-based, although, as I said, there are online versions out in the marketplace. So the next stage, once the application has been received, one of the things that, and there's a departure in the way in which this is dealt with in the marketplace, and it may be that you have transfers. In our case, we ask you to actually go to the seeding scheme with the transfers and to obtain transfer discharge forms. Why is that important? Because it actually covers off any charges that may be applied, and you actually find out what the true value of the transfer is going to be before it's too late. So that gives you an option to look at that. So what we would expect to receive is the application forms, and either at outset or over a period of some weeks, the transfer discharge forms in respect of each of the arrangements that you're looking to transfer. Those are then processed and completed, and there's a section usually for you, the member, and then a much larger section that we as the scheme administrator have to then complete. And then we would send those off to the seeding scheme. We normally send those by guaranteed next day delivery. Why? Because it's amazing how many insurance companies and other seeding schemes miraculously find the paperwork when it seems to have gone missing, when you can produce that wonderful postal receipt and the signed for process. So where do we go with the actual timescale for transfers? Well, to some extent, sadly, it's how long is a piece of string. Typically, simple personal pensions may take a month to 2 months for insurance companies to process. But we do know of occupational schemes in the marketplace that can take over 9 months. So again, it's quite important for you to actually establish in terms of your decision to transfer an arrangement, to actually question the seeding scheme as to what their likely timescales are going to be. We're, to some extent, powerless to influence that, and actually it's you, the member, that has much more influence as the client of the seeding scheme to push to get those progressed as quickly as possible. But the key risk there for you is that, of course, you can be taken out of the market for a particular period of time whilst that transfer takes place. And that's, another consideration you need to make. So in terms of administrators and trustees combining the role, no, they don't have to combine the role, although many do. In terms of the SIPPs, we've looked briefly as part of our health warning at charges. But you may want to look at trustees and administrators in terms of the size of the operation. Very often, coming from the small self-administered scheme market, numbers of companies have moved into the SIPP market, but they're relatively small players. And this is where systems can play quite an important role in how the SIPP is managed. And many of the smaller operators are based around spreadsheets, but there comes to a certain point where spreadsheets really are just not up to the mark in terms of dealing with administration. And really, you need to be looking for people with scalable systems. Having said that, there are quite a number of companies that are very large companies, but they're running with legacy systems. So it is quite important to try and find out a little bit more about how your SIPP operator is actually going to process and administer your business, how many clients they've got, and whether, as I've said, the systems and the infrastructure is actually up to scaling that business, or whether they might have some issues later on. And remember, SIPPs are almost for your lifetime. So a SIPP could be taken out over many, many, many years. It's not a product, it's not a timeshare arrangement, as indeed many of the old type of pension schemes used to be. So this is quite an important consideration. You're getting into bed with a SIPP operator who's going to be your partner over a considerable period of time. In terms of the application, you're going to have to provide the provider with your details of your identity. This is all part of anti-money laundering provisions, and typically some of the providers may well use electronic and automated processes such as Experian. In other cases, or if you don't pass the level of Experian check, then you'll be required to provide photo ID and indeed details of utility bills. But again, you need to be careful to make sure that these are ones that you have your home address and are not internet-based. So mobile telephone bills, for instance, would not be acceptable. So having dealt with the application process, having verified your identity, the investment account is going to be established. And it may be that there are arrangements between the trustee and administrator for ID to be shared. That can be done. Or alternatively, the investment company, the stockbroker or investment company, may actually have its own anti-money laundering arrangements. So be prepared that you may have to duplicate that particular activity. And indeed, in terms of other investments that you might take on within the SIPP, it's possible that other bank accounts or banks and other financial institutions will also want to verify your identity. So we've established the scheme, and as part of that establishment, as I said, most providers would be sending out a pack that confirms all the details around the SIPP. It's important to read through all that information and to really make sure that you understand all the charges that are likely to be applied, not just at outset, but during the duration of the scheme. And again, an important area is to look at, for instance, when you're incurring the costs of dealing with the stockbroker, but are they providing automated data feeds to the receiving scheme, which can save costs in terms of recording what's happening, or are we in a situation where contract notes perhaps have to be loaded manually, which obviously may incur you costs. And we'll come to retirement and claims costs in the future webinars. So in order to get the SIPP actually accepted, we need to receive some money, and that typically will come through contributions and or transfers. With contributions, if it's a member contribution, then we'll be involved in claiming tax back in relation to that contribution. Once the case has been accepted, the next part is to make sure that the cancellation period either still applies or has expired. So it may be that funds can't be moved straight over to your investment counterparty because that cancellation period has still not expired. However, as I said earlier, you have the option of actually closing that cancellation period out. So once in terms of the actual dealing account, the things that we're looking for as a trustee and administrator is to make sure that funds can't escape that account, that it's completely ring-fenced. So we will send the funds across to your order, to the dealing account, and we delegate authority to you to actually deal on that account. And that is where I was saying earlier in the health warning, you really do need to make sure that you are comfortable in actually investing probably the most valuable asset that you have, which is your pension scheme. Very important that you're comfortable with that before you take on a SIPP. In all other respects, you're going to be dealing just as you'd be dealing and have possibly been dealing on an ordinary dealing account. You will you'll deal against cleared funds, contract notes will be issued, etc. In terms of transferring existing pensions, it's probably well worth doing some research. For instance, final salary schemes are a real worry because people seem to think, well, I can take my final salary pension scheme and transfer it into a SIPP. Well, actually, can you do better? The presumption of the Financial Services Authority is that you should not. And indeed, we as a trustee insist that if you're considering transferring a final salary scheme, that you actually obtain proper financial advice and a verification of whether that transfer is actually in your best interests, because you may be giving up quite considerable benefits and guarantees. Other pension schemes, what you need to be looking at, if they're money purchase schemes, is, well, what are the exit penalties? In other circumstances, you can actually transfer in what we call in specie. So, for instance, if you already had a SIPP perhaps with another company, it may be possible for you actually, rather than having to cash in those investments, to actually transfer them from one scheme to another in what we call an in specie manner. And there we put the two brokers together and they will effectively transfer the assets between them. In terms of timescales, as I said earlier, it can be problematic in terms of transfers because we're not in control of the administration of the seeding scheme. Other considerations are that if the transfers are in specie, then it may be that certain assets are actually quite difficult to transfer. Equity transfers within Crest can take very little time at all. But if, for instance, it involves, say, the conveyance of a property, that obviously is going to take much longer. So it's very difficult to actually give an average. And as I said earlier, we can see situations where some take weeks, some take months, and others can take even longer. One of the questions that we often get about SIPPs and SIPP dealing accounts is, can we bed and ISA the SIPP? Well, actually it doesn't work like that, were it that simple. The situation is that if you want to introduce funds to a SIPP, it can only be introduced in certain ways, like a transfer value or a contribution. Now, since pension simplification in April 2006, it has been possible for members to actually enter into transactions with personal assets, but it has to be done on open market terms. So effectively, to introduce assets in specie, then that would have to be a contribution, and we get into the complexities there of having to create a debt. You satisfy the debt by the supply of assets, the stamp duty payable, and because you actually have to nominate the contribution, it isn't as simple, unfortunately, as just transferring an asset and taking that as the value of the contribution. You may have to top up with cash, or if you end up with too much asset being supplied because of a price change at the time of delivery, then you may end up with a situation where we have to not only have an in-specie contribution, but we also have to make a purchase from you, again at open market terms. Now, we'll go into more detail on the different types of investments in later webinars. The other situation with purchases of assets, as I said, it is possible to deal with yourself, but on open market terms. But one of the advantages of using a stockbroker with assets is that you may be able to actually close out the spread by doing what is an old-fashioned sense called an agency cross, or in the more modern parlance is a put-through. So that sort of closes off my session in the webinar for this week, but I shall hand you back to Dave for questions and answers.
Well, thank you, Francis. I think we've taken you quite quickly there through some of the issues around actually getting your SIPP established. And in the next seminar, we'll certainly be going on to talk about how you actually manage your investments and the type of investments that you can hold. Now, we've received a number of questions, Francis, from people who are talking about protected rights and whether they can transfer those into their SIPP. For people who aren't quite sure what protected rights are, perhaps you could give us a brief description of that and then go on to talk about what they can do with that once they've transferred it in.
Okay, that's a very topical question. Basically, protected rights primarily are derived from individuals who have contracted out of the what was called the State Earnings Related Pension Scheme, SIRPs, or is now known as S2P. Now, protected rights are actually going to be abolished in 2012, but in the interim, we actually have to take care about protected rights in terms of actually tracking the amount of protected rights funds held within the SIPP. Now, until October 2008, it was actually not possible to transfer protected rights into a SIPP scheme. But from October 2008, it became possible. As I said, scheme administrators and trustees or operators have to make sure that they track those protected rights. But in all other respects, they can be invested in just the same way as non-protected rights. Is a slight mouthful, but basically we have protected and non-protected rights. As I said, from 2012, protected rights will be swept away, but until then, scheme operators have the responsibility to make sure that when benefits are being paid, there is something called proportionality exercised between the amount of cash that's taken from protected and non-protected. Now, some providers deal with that by keeping protected rights and non-protected rights entirely separate. Others do it on a mixed fund basis. So again, that could cause some cost issues. So it's well worth, again, asking your provider in advance if you've got protected rights. There is one other area of protected rights which is slightly more technical, coming from final salary schemes where people have what we call 9(2)B rights, which are automatically converted into protected rights when they come to a personal pension scheme. That's a much more technical area, and again stresses the importance of having proper professional advice before you even entertain taking any benefits out of a final salary scheme.
Well, that's useful. Thank you, Francis. And Lewis, in fact, has sent us a question which follows up on that, where he asks whether you need to keep them segregated and invested separately. And if I'm understanding you correctly, that will depend very much on the trustee administrator arrangements and how they deal with it?
That's exactly right, Dave. It may even come down to systems, and that was a point I was trying to make earlier in the presentation, that systems are key to the proper running and efficient running of SIPPs. Some systems are up to running protected rights and non-protected rights together, others are not, and that could have cost implications and frustration issues in the sense that if you can't combine them, you can end up with a situation where you're actually having to do two deals to try and perhaps have the same spread of investments.
So I think the advice there would be that if you have protected rights, it's certainly worth looking to see how the administrator you're thinking of working with would handle those. Now, Francis, you mentioned earlier the question of transferring in particularly company pension schemes and the need for advice. And Neil has sent us a question saying that he's got two private paid up pensions and a company pension, and he wants to know whether he can put those all together.
Well, I think the easier ones are the two private ones, which might be retirement annuities, or they might be personal pensions, or they could be stakeholder pensions, or they might even be personal pensions. Those are all relatively easy because, of course, a SIPP is a personal pension, but as I've said before, a SIPP is a personal pension with attitude that has much wider investment possibilities. The company pension is always a worry because is it a money purchase company scheme, a defined contribution scheme, or is it a final salary scheme? Now, I've already, I think, exhausted the point about needing strong financial advice around a final salary scheme, but also I think with a company scheme, if it is money purchase, well then you're moving from one money purchase environment to another money purchase environment. But again, it's very important to make sure that there are no linked benefits. I suspect if the arrangement is paid up, then Neil may well have actually left his employment and therefore those benefits have been terminated. But certainly any money purchase to money purchase transfer is something that is much easier for the individual to actually work out, well, is this going to work for me?
And in fact, if you do combine those, Neil, and it makes sense for you to do that, then of course you've got one pot that you can manage together, and that often makes for simplicity. And I think that's probably true, Francis. I know you were mentioning at the seminar we did that having your other investments in the same place as your SIPP in terms of dealing enables you to sort of have a look at the whole thing in one go and ensure you're not duplicating investments. So Neil, that might be quite a good thing for you to be thinking about there. Andy's asked about cash, but before I come to that one, Francis, Eric sent in a question where he's talking about a final salary scheme and wants to know whether that can coexist alongside a SIPP.
Yes, it can. I think one of the issues here is, how funded is your final salary scheme? Are you still in your final salary scheme, or is it frozen? Now, what I've obviously been saying with the health warnings about final salary scheme transfers is it may well be the best thing to do to leave it in a frozen state. But equally, there could be concerns about whether the pension scheme actually has sufficient solvency in it. Can the sponsoring employer actually maintain that scheme? So that's an issue that could come up. But certainly, yes, a SIPP can coexist with company pension schemes. We need to put that all into the context of the fact that pension schemes now are subject, since simplification, to a lifetime allowance. And you may have read recently of changes that are proposed for the reduction of the lifetime allowance from what was going to be 1.8 billion down to 1.5 million as a maximum fund. And so, again, you need to look at the funding. How big is that final salary scheme going to be in terms of the funds, and therefore what headroom you've got perhaps to fund a SIPP separately to top up that fund.
So would I understand that right, Francis, that as a SIPP administrator or trustee, you'd have to liaise with the other pension schemes to see how far people have got along that maximum ceiling?
Well, no, that's not actually our responsibility. That's going to be the responsibility of the member. So it will be important, and this is one of the difficulties. One of the great advantages of having everything consolidated into the SIPP is you've got one picture. You don't have to go ferreting around, collecting all the paperwork from different schemes, which historically has always been the position. There's always the joke of the solicitor with huge shopping bag full of old retirement annuity policies because he used to take out one with a different company every year. SIPPs get over that particular hurdle, but where we get involved very much in terms of the lifetime allowances around what we call benefit crystallisation events, and we'll be talking about these in the future webinars when we come to the claims process. But what we have to obtain with the members' help is a situation where we ask for a lifetime allowance questionnaire, and therefore the member has to go out and either himself or if he has an advisor to collate all the information about all of the pension schemes so that we can assess whether there's any headroom, whether there's going to be tax payable if people have funds in excess of the 1.5 or what will be the 1.5 limit.
Thank you. And we've obviously seen the changes that have come about recently from the change in pensions legislation, where the amount of money you can pay in annually is going to be capped at £50,000 tax-free. Does that same thing apply there? Is Eric going to be, on people in Eric's situation, going to be responsible for monitoring that too?
Well, in terms of the 50,000, we must just remember that of course is proposed to come in. We need to see the legislation for that.
Indeed.
And that's going to come in from April 2011. In the meantime, we're left with the previous government's legacy of a tapered arrangement. So any contribution this year over £20,000 may be subject to recovery if you have income over 150,000, and there's a tapering effect there. What I think we're very pleased to see in the interests of simplification is, although the new coalition government has imposed a limit of £50,000, then the situation there is that at least that's simpler. It isn't perfect. It doesn't help the self-employed. It doesn't help the entrepreneurs who may have variable income. But I always have a saying in our industry: what goes around comes around. And some years ago with simplification in 2006, we saw goodbye to the concept of carry forward and carry back. And hey, just what's turned up again now is we're now going to have carry forward for those people that pay in less than the 50,000 going forward. And if you need to be aware of this, because of course carry forward is actually going to apply immediately. So those of you who are paying in less in this current tax year and the previous tax year could, if you've got sufficient earnings, actually pay in more than 50,000. But there's some technical stuff around that obviously will be made clear ahead of next year. The 50,000, no, we need to do two things. One, when we're taking on contributions, we need to actually make sure that you have sufficient earnings. So in our case, we actually ask you, the member, to provide us with evidence of earnings. Why? Because we don't want a situation where somebody completely miscalculates their earnings, and then there's all sorts of complications in terms of trying to sort that out, and it's a real headache. So we do ask for evidence, and indeed in a sort of fairly recent, in the revenue audit, they applauded us for that approach. So it's not actually a requirement of the revenue to ask for earnings, but they thought our approach actually was very sensible because it does keep people on the straight and narrow. Now, if you end up making excessive contributions, then there is going to be a recovery charge. So
one certainly to keep a close eye on.
Absolutely.
Good.
Yeah.
Eric raised an interesting point too in relation to his earlier question, which was this issue about the change in requirements within the SIPP. You mentioned earlier you might start off with one that's fairly basic and you might have a very limited range of investments, but as your pot grows and as your experience grows, you might want to broaden it out. If you needed to transfer, is that an expensive process? Does it take a lot of time?
Yes, well, I think one of the issues, as I was saying earlier, is that pension scheme provision in sort of what I almost refer to the bad old days was very much around single premiums quite often, different providers, completely fragmented provision, and of course every scheme that you have is actually charging you. So the advantage of being able to combine everything into a SIPP is great. Now, again, at the head of the webinar, I referred to the fact that you need to look at the types of facilities that you actually need in order to run your SIPP, and that there's no point, taking out an all-singing, all-dancing, very expensive SIPP if you actually all you want to do, taking a very extreme example, is to hold the assets in cash for a period. Or to perhaps focus on a particular dealing account. Now, the type of structure that we run is actually very flexible because we allow people to actually come in at cash or come in at, say, using a self-trade SIPP dealing account. But there may be a situation where, good as the self-trade SIPP dealing account is, actually there may be a market or there may be a type of asset. Historically, that's tended to be around mining assets. Which were very popular, actually perhaps you need to appoint a second broker to handle those. Now, a scheme like ours can automatically accommodate that by moving people up in terms of upgrading the facility with wider investments. And indeed, having sort of been working with perhaps equities and ETFs and other types of assets, maybe one of the intentions was to actually buy a commercial property. And again, we can upgrade. Maybe somebody wants to look at personal equity. Maybe somebody wants to look at hedge funds. So the issue out there really is that you can have a situation like working with us where we can accommodate all those different levels within one scheme and basically just upgrading for the marginal cost between the annual charges.
Right.
However, there are other constructions in the marketplace where, there are very decent providers that are also using self-trade, have very cost-effective arrangements. But, and this is the big but, when you then want to upgrade, then it involves transfer out. And any transfer out, you need to think about the charges, you need to think about the time you're going to be left out of the market for. So it's quite a consideration.
So I think the watchword there is planning ahead, and as Francis was saying earlier, when you're making your initial assessment of the type of SIPP that you want and the sort of assets you're going to hold in it, then think about where you might want to go in the future and what might happen, how your circumstances might change, and ensure that you're choosing somebody that can accommodate all of that. Now, I think we've got time for just one quick question. We are very close to the end of our session, and thank you very much for bearing with us, and I hope you found it useful. But there's a question from Andy about cash, and perhaps I could answer that one for you, Francis. As Self-Trade doesn't run deposit accounts itself, but the administrator that you choose typically will have arrangements where they can hold cash in deposit terms for you. So you wouldn't do it within the Self-Trade dealing account. That's very much the money is there for your trading purposes, but your administrator would normally be able to hold cash for you elsewhere that would pay you a bit more of an interest rate than Self-Trade certainly would do.
Can I jump in there?
You can indeed, Francis.
Because actually that's a very interesting point, because when we had the banking crisis, there were very few providers that could offer what we call external accounts. And indeed, we have been one of the few players that can offer a range. I think the other way, of course, of being able to invest in cash is to think about a mutual fund. And I think within your range of funds that are traded on the self-trade dealing platform, that there will be a number of funds there
Indeed.
that are indeed cash
Indeed there are.
funds.
Indeed there are.
That's another way
That's
of
quite
doing
right.
it.
Thank you for that. Kishore's sent us a question, if I could just briefly ask you to comment on one particular point of that, Francis, and that is, Kishore's talking about transferring a pension from Barclays to self-trade so he can manage it himself, and says, why do I need a trustee administrator?
Well, sadly, what you'd need to do, Kishore, is that if you wanted to run it yourself, it would be possible, but you'd need to get regulated by the Financial Services Authority. You would need to have your own trustees and rules, which obviously you need to go away and pay a lawyer, and that may be many thousands or even tens of thousands of pounds to achieve that particular bit. And then you're going to have to do all the reporting that's involved with the Financial Services Authority. You're going to need to do all the reporting and work in terms of collecting tax, in terms of member subscriptions. So if you were personally making a contribution, you would need to go through that tax reclaim process. When it comes to benefits, which we'll come on to in later webinars, then you're going to have to account for tax to the Inland Revenue. So I'm afraid, it's probably one of those situations where you're going to get a more cost-effective solution by actually passing it over to a trustee and scheme administrator.
It certainly sounds to be the case, Francis, indeed. So let me just, if I may take a moment for a quick plug for the next two webinars. You'll see on your screens details of those. They're also available on the Self-Trade website. And in a week's time, we'll be back here again with you. I hope you can join us. And we'll be talking about the process of actually managing your investments, the sort of investments you can hold, some of the complexities. I'm sure Francis will be talking about property and residential property, maybe even touching on what you might do with your antique bottles of wine that you're laying down for posterity. So I do hope you can join us next Thursday for that one. And then the week after, we'll be back for the third in the series, and we'll be looking about what you actually do when it comes to taking your pension benefits. Obviously, that's the purpose that we're all running our pension for. And I hope, Francis, we'll have a bit more clarity about some of the changes that are coming through by that time.
Yes, we're always hopeful, but there's some big changes coming up in the retirement zone, and I'm not sure we're going to have the answers by then, but here's hoping.
So we'll give you the best of steer as we can, and you can be sure that we'll keep the details on the Self-Trade website up to date on that as well. So thank you for joining us this evening. We look very much forward to joining you again in a week's time. In the meantime, from myself and from Francis, thank you and good night.
Thank you and good night.